Welcome to Capital Insights. Thanks so much for being with us today. Well, we're fast approaching the end of 2015. Time for a little look into the new year. And I thought what might be important today is if we had to just pick one issue for the economy, one issue for the interest rate markets, one issue for the stock market, what would it be as we look into 2016? We all know many issues affect the economy and the markets, but I thought I'd kind of cut right to the chase and give you a little preview of what we're looking at next year, picking just that one major issue for each little subtopic. The U.S. economy. We've discussed this many times over the last year or two. The economic recovery that we're living in at the current time is one of the most subdued on record. That continues into 2016. We don't look for fireworks either on the upside or the downside. But if there were one issue that might most importantly impact the U.S. economy next year, what would that be? And although this may sound like a wild answer, the most important issue for the U.S. economy in 2016 is the non-U.S. economy in 2016. And what I really mean by that is the international markets, and very specifically, the emerging markets. Remember, China is one of the key poster children, in the emerging market subset, but there are many others out there, and they've had a very tough time this year. What's really different is this. If we roll the clock back over the last 15 or 20 years, we need to remember that one of the key investment themes globally, not just in the United States, but globally, was the buildup, if you will, of the export capabilities of the emerging markets. We're talking about Brazil, we're talking about India, we're talking about Russia, we're talking about China. That was a theme that lasted a good decade and a half to 2 decades. And what it did was make commodity prices very strong. There's a lot of imports into the emerging markets to build up those export-driven economies over time. Well, as melodramatic as this may sound, that theme is coming to an end. What we're finding is that demand on a global basis here has been very subdued. And those, export behemoths that were the emerging markets are having a very tough time. And as a consequence, they're no longer building up the export side of their economy anymore. In fact, China, again, being very much a poster child for this, is really focused on balancing their economy over the next few years. And that's really a balance between export capabilities, but also internal consumption. Now, this is a little bit wild, but when we look back over the last probably 50 years of U.S. experience, and probably more to the point, the last 20 years, it's really been the U.S. in the driver's seat. The U.S. catches a cold, the rest of the global economy gets sick right along with it. But never have we really experienced a period where the global economy in the emerging markets has a problem that ultimately migrates into the United States. Again, will this happen? Won't this happen? We don't know for sure. But if we had to pick just one issue looking into next year, it's what happens in the emerging markets that may ultimately precipitate a potential global economic downturn, a global economic recession that may drag the U.S. into it. Again, the reason we think this is important is because number one, it's really never happened before, and number two, very few people are looking for something like this. But I'll give you a quick anecdote of how this does impact the U.S. economy and what we need to be mindful of as we kind of round the turn into the beginning of next year. Caterpillar. Very large U.S. company, very large manufacturer. What has Caterpillar experienced over the recent past? Well, Caterpillar has the distinguished honor, if you will, of having 36 straight months now of down worldwide sales. That's a long stretch. In fact, it's never really seen that kind of a stretch in its history. And what does that mean? Well, is that because China's not building up export capacity anymore? Is that because China has stopped using earth-moving equipment and building up cities and commercial real estate? You bet it is. And it's not just China. It's a lot of other parts of the world who are, if you will, buyers of Caterpillar equipment. And what does that cost? Well, Cat's going to lay off 10,000 people in the next 3 years. It's already started. So that's just an example of how the global economy can impact the U.S. economy itself. Right now, as we head into the end of this year, the manufacturing sector of the global economy, or the manufacturing sector of the U.S. economy, is having a very tough time. In fact, we would characterize it as being in recession right now. And this is really a result of what's happened in the global economy, not necessarily the domestic U.S. economy. What's holding up the domestic U.S. economy right now is really the service sector. So again, as we look into next year, that's the key in our minds. What happens in the emerging markets, what happens in the global economy will be very, very important for domestic economic outcomes. Because outside of that, the domestic U.S. economy is muddling through, kind of as it has been for the past few years. So we'll keep our eyes open, and we'll have a lot more to say about that as we move into next year. We happen to be filming this a little less than a week after the Federal Reserve has raised interest rates for the first time in 9 years. You know, it's one of the longest stretches in the United States without an interest rate increase. And this is just a offhand fact. Every single sitting member of the Federal Reserve Board right now wasn't there when the last interest rate increase happened. In fact, this is the first interest rate increase on their collective watch. It's up 25 basis points, or 0.25%. That's where the Fed has brought very short-term interest rates. So after earning next to nothing in your money market fund for the last X years, you're going to earn a little bit more than next to nothing as we move into the beginning of next year. Will the Fed raise rates again next year in 2016? The jury's out for now, but it's a pretty good bet that they will. But to be honest, what's most important for the interest rate markets as we look into next year is not what happens with interest rates. In fact, not in the least. It's almost a sideshow. We need to remember, over the last 6 or 7 years, in addition to lowering interest rates, and we've talked about this many a time, and it's not just the Fed, it's also their global central banking brethren, they have printed money. And in essence, what's really happened is the Federal Reserve has, if you will, are they really printing dollars in a back room? No, they're not. They're creating electronic digits. But they are creating this money that they have used to buy financial securities from largely the banking system and from the open market itself. In fact, the Fed has printed close to $4 trillion over the last 7 years doing this activity. And unfortunately, what's really happened is it's ended up as excess reserves in the banking system and gone right back to the Federal Reserve itself, because the Fed pays banks a quarter point on all of their excess reserves. So one of the little problems with money printing is the money never really got into the real economy. It really stayed in the financial markets more than not. But we need to remember, interest rate declines on one side, but printing the money on the other side. Over the last 7 years, the Fed has built up a balance sheet. They've built up a balance sheet of assets they've bought from the financial sector. They own close to a third of the entire 10-year U.S. Treasury market right now, and they own close to a third of the entire mortgage-backed securities markets. Well, what's most important is this. Over the next 3 years, $2 trillion in Federal Reserve financial asset holdings are going to mature. They're going to be paid off. The key, looking ahead, for both bond markets and interest rate markets is, what will the Fed do? Will the Fed re-up? Will it, in essence, take those maturities on its balance sheet that it's going to receive cash for and buy new securities? Or will it, in essence, retire those securities and shrink its balance sheet? If it shrinks its balance sheet, it's removing liquidity from the financial markets. And you already know this. If they own U.S. Treasury bonds and they get paid off, if you will, the United States isn't going to pay down that debt. They're going to refinance that debt. That's what we've done for decades and decades now. So in essence, what that means is, if the Fed doesn't buy these securities, someone else is going to have to buy them. Whether that's the pension funds, whether that's sovereign wealth funds, whether that's individual investors. And the key really becomes, at what price? Over the last X years, as the Fed has printed money and bought securities, they've been completely price insensitive. They aren't waiting for great deals. They're just spending the money. As we look forward, if they do not reinvest the securities on their balance sheet that's maturing, the open market is going to have to refinance those securities to the tune of close to $2 trillion. And what does that really mean? Well, what that really means is it's a removal of liquidity, financial market liquidity, by the Fed itself. You don't hear this talked about on CNBC. The Fed doesn't talk about it in their minutes, to the Open Market Committee, but it's going to be very important. We're going to see, and we're going to know what the decision is in relatively short order, as these maturities on their balance sheet will start occurring by mid-year 2016. So although next year, I promise you, this is what's going to happen, we'll have a ton of fanfare and a ton of media speculation and coverage of every little single Federal Reserve meeting where they talk about interest rates. But trust us, interest rates themselves are a sideshow. What the Fed does with their balance sheet will be the most meaningful impact for the bond markets and the interest rate markets ahead. Finally, the stock market. Stock market this year, it's been an exercise in volatility, hasn't it? The S&P started the year at close to 2,060, and we're a little bit below that today. But wildly enough, if you look at every single close of the S&P every day and add all those numbers up, all that travel, all that movement, the S&P's traveled more than 3,000 points this year to end up a number of points below where it began the year. A lot of volatility. Well, we've mentioned this before, and we think it's very, very important. As we look into next year, what's going to be very impactful for the equity market, for the U.S. stock market, is what happens to the U.S. dollar and what happens to foreign flows of capital. Foreign flows of capital have been a huge underpinning to really the U.S. financial markets and real estate markets for the last 2, 3, 4 years. We already know there's been a lot of currency debasement in places like Europe, places like Japan, now in China, and a lot of that money, Chinese money in the renminbi, Japanese money in the yen, European money in the euro, it's looking not to be debased. It's looking for a safer home ahead. Will that continue in 2016? We already know a few things. Number one, we know that equity market valuations at the moment are very, very high on a historical basis. They're the second most highly valued that we've ever seen in the entire history of the market. There's only one other year that's eclipsed this one. And it begins with a 2 and ends with 3 zeros. You may remember that year very, very well. But that doesn't preordain anything. Again, it's that latent movement of global capital and what would accelerate money coming into the United States, both the financial markets and even potentially the real estate markets, is a higher dollar. Well, number one, when the Fed started raising rates last week, they are now the only single bank on planet Earth, central bank, that's actually raising rates. And when a central bank is raising rates, academically, it's supportive of the currency because all the other major currencies are debasing their currency. So we may see more, and that would be a key underpinning to the stock market. But it doesn't stop there. We happen to be filming this on December 21st, and over the weekend, the United States passed yet another government shutdown saving bill. Boy, I don't know about you, but I was glued to my seat on that one, right? We continue to borrow money. We all know that. That's no surprise by any means. But bills never happen in the U.S. Senate or Congress without a bunch of, if you will, additional bills being attached onto them. And one of the bills, one of the attachments to the bill over the weekend was the elimination of taxes on foreign investment in U.S. real estate. And this is specifically important for the pension fund industry globally. Again, remember these foreign pension funds. They exist in a world of currencies that are being debased out from under them. They're looking for safety, they're looking for quality, they're looking for liquidity, and it's the U.S. dollar markets that really provide that. So the U.S. government, too, just gave foreigners another reason, if you will, to invest capital in the United States. This is going to be one of the most important issues as we look forward. So again, I know this is very quick, I know this is very short. We'll be discussing all of these themes in much greater detail, and we'll be writing about them as we turn into 2016. Again, we very much appreciate your time in being with us. On behalf of the entire team at Capital Planning, we wish you and your family a fantastic holiday season and all the best for the new year ahead. Health, happiness, and prosperity, necessarily in that order. Thanks so much.